Hi everybody, thanks for taking the time to watch this video. Today I'm going to discuss something known as the Social Security tax torpedo and a related topic, the capital gains bump zone. These are two intricacies or pitfalls you can fall into within the tax code. In order to explain these, I'm going to provide an illustration. So let me get into that. Okay. So in retirement, you're going to have some income, hopefully. And some of this income is going to be what is classified as ordinary income. That could be income from a pension, an annuity. It could be distributions from your IRA or 401k. But also certain parts of your Social Security are going to be taxable as well, depending upon how much income you have from other sources. So this ordinary income is going to be taxed according to the ordinary income tax brackets. And there's different brackets according to how much you make, and you will be taxed accordingly. In addition to ordinary income, some of you will have a portfolio where you're getting dividends or taking capital gains. And the capital gains have a different tax bracket system. In particular, one thing that I like to highlight is there's actually a generous 0% tax bracket. But now, as you can see from this illustration, capital gains, they don't start over from zero. They start from where your ordinary income left off. So they effectively stack on top of your ordinary income. So we got this 0% tax bracket, then we got the 15, there's a 20, and there's a little bit more if you're getting hit by some other fees or taxes. But the point is, your capital gains are going to stack on top of your ordinary income and going to be taxed according to their brackets. Now, for this example, the Social Security tax torpedo and the capital gains bump zone, I'm going to consider what happens to our taxes when we add a $1,000 distribution from our IRA. So the first thing you're going to know is that's going to add $1,000 to your ordinary income, and that is going to trigger an additional 12% tax on that $1,000 distribution. But as you also saw, the extra $1,000 of ordinary income pushed your capital gains up. In particular, it pushed some of those that were still sitting around in the 0% tax bracket into the 15% tax bracket. So what happens is you get an extra $1,000 of capital gains taxed at the 15% rate, another $150 of tax. Now, the next thing to consider is, well, we just took some more income, both $1,000 IRA from the $1,000 IRA distribution, and this has an impact on the taxation of our Social Security. In this example, and in many real-world life examples, which I will share at the end of this video, this can make more of your Social Security taxable. In this example, it makes an additional $850 of your Social Security taxable as ordinary income. So that money comes right over there and ends up being additional ordinary income. And as you can imagine, this pushes up the amount of ordinary income, but it also pushes up those capital gains again. So we're going to see an additional $850 of ordinary income. So that means we're going to have another $850 taxed at the 12% rate. But then we're also going to see we're pushing up more of those capital gains into the 15% tax bracket, another $850. So that's going to be another $850 of capital gains taxed at the 15% rate, another $127.50. All total, we have almost $500 of additional taxes on a $1,000 IRA distribution. That's almost 50%. We're floating along over here in the 12% tax bracket, which is a great place to be because the next tax bracket above that is 22%, but we just blew that out of the water because of the way Social Security interacts with other income. So this is really a really important area to be aware of and to optimize or strategize around in order to minimize your taxes in retirement. But it doesn't stop there. There's some other things I've ignored or brushed under the rug here. Some of us are going to trigger other taxes or related costs, such as IRMA, our income-related monthly adjustment amount. That's our Medicare surcharges, net investment income tax, healthcare subsidies, childcare education credits, things like that. The way I see it is we're dodging a lot of different arrows when it comes to taxes in retirement. The analogy that comes to mind is if you've ever seen one of those movies where they have to dodge the lasers in order to get to if somebody's going to try to steal some valuable object or piece of art, they have to dodge all these security lasers. And that's really the way I see it, because we've got income tax, capital gains, we got the Social Security, the tax torpedo, and the cap gains bump zone. We also have IRMA, net investment income tax, and the subsidies and credits. It can be quite challenging, and it's quite technical as well. So this is one area I like to highlight where it makes the value of financial planning quite high in many circumstances. Thanks again for taking the time to watch this video. If you'd like some help with your financial planning, please feel free to get in touch. I offer everybody a free consultation. All you have to do is go to my contact page and sign up.